Okay, all right. Can anyone see that I'm recording, just to be sure?
Yeah.
Okay, perfect, thank you. So the first problem is on short-term debt refinancing. Basically what it is replacing the short-term debt with a long-term instrument, a loan, or equities like common stock. This really affects the current ratio most of the time. So investors or other people looking at the financial statement are going to look at this ratio and see like, oh, you have 5 million that you need to pay in a year and you don't have the cash asset, like what's going on. So that's one of the issues with it. And also, if you think that you're going to refinance it in the next year, are you supposed to put it in your current liabilities? Are you supposed to put it in your long-term liabilities? That's like the issue with it. There's two ways. Well, there's ACCO and IFRS. They both look at it differently. But before I go into that, there's a guy on YouTube, Farad, that does really great videos. I'm gonna put the link in the chat. If you still have questions after, I really recommend checking the video. It's really helpful. And also any topics in financial accounting that you have any questions, he probably has a video on it. So just look at it and try and understand it. He's really makes it clear. So to go back to the criteria, there's the ASPE criteria. There's 3 things that needs to be checked off before you think about putting your short-term debt that is refinanced in your long-term liabilities. The first thing is the refinancing done with a long-term instrument? So is it done with a loan? Is it done by selling common shares? The second thing is the refinancing done before paying off the short-term debt? So if you pay off your short-term debt, let's say in January, and your refinancing is done in February, but your year end is December 31st, you actually paid it off within a year. You paid all your short-term debt within a year. So it should be in your current liabilities, current liabilities for your year end December 31st. It doesn't make sense to switch it and put it in your long-term liabilities. And 3 is the refinancing done prior to the financial statement release. If your refinancing is done in September and your year end December 31st, so let's say it's December 31st, 2021 is your year end, and you have a refinancing done in September 2022, you're not going to go and amend your financial statement that were released in March just because now you have a refinancing. You're going to figure it out at the next year end. For ASPE, all of these criteria must work for it to be put in the long-term liabilities. For IFRS, at year end, does the entity expect to refinance it or roll it over under an existing agreement for at least 12 months? And if the answer is yes, then the management can decide to put it in the long-term liabilities or the short-term liabilities. It's up to them. So before I go into the problem, does anyone have any question on this? All right, so I'll go into question. XYZ company has a $5 million short-term debt at its year end on December 31st, 2021. The company enters into a refinancing agreement on January 25th, 2022 with their bank to ensure sufficient funds to repay its short-term debt. The bank loaned them $7 million due in 5 years. On January 30th, 2022, XYZ Inc. repays its $5 million short-term debt with the amount received from the bank. The financial statements are released on March 5th, 2022. There's a little error here. The first requirement is under ASPE, how would the $5 million short-term debt be presented on the December 31st, 2021 balance sheet? So for ASPE, we look again at these 3 criteria. The best way to do it is just do a little timeline and figure out where all the days go, and then you go one by one. Okay, does that check, does that check, does that check? So I'll do that first, the little timeline here. So the first date we have is the year end on December 31st. So I'll put December 31st, 2021. What happens then? It's the year end, and they have a short-term debt of $5 million. After that, we continue on January 25th, 2022. There's the refinancing agreement. So January 25th, 2022. Refinancing, and it is for $7 million due in 5 years, so it is a long-term liability. So $7 million. And on January 30th, they pay back their short-term debt with the refinancing. So it's minus 5 million. Okay, they don't want that. Pay back. All right, and then the last date is the date of the final statement release. So it's March 5th. And it's release, financial statement release. So we go back to your criteria. One, is a refinancing done with a long-term instrument? The answer is yes, it's done with a long-term debt of $7 million, so that checks it. The amount is also greater than our short-term debt, which is good, because we don't have to ask ourselves the question, do I put it all in long-term liabilities? Because the amount is greater. We're going to look a little bit later what happens if the amount of refinancing is lower than our short-term debt. So this is a first yes. Second, is it done before paying off the short-term debt? Refinancing is done on January 25th. On January 30th is when you pay it back, so that's also a yes. And is the refinancing done prior to the financial statement release? Yes, the release was on March 5th. So in the financial statement, you can put it all in your long-term liabilities on December 31st. So you're gonna have $5 million. $5 million. Your 2 million of like 7 million minus 5 million is going to be on your next year financial statements because it is done in the next year. So in the next year, you're going to have 7 million instead of 5, but we're just looking at 2021. All right, so for question 2, under IFRS, how would the $5 million short-term debt be presented on the December 31st, 2021 balance sheet? So for IFRS, it's at year end. They have already an agreement that they can roll it over. For this one, what happens to the 2 million for next year? Yeah, so basically, we're looking right now at December 31st, 2021. We're just looking at the short-term debt that was here, so the 5 million. But on December 31st, 2022, you're gonna have your 5 million, which is your rollover. But since you also got, since you got a loan of 7 million, you have to add the 2 million difference. So you're gonna have 5 million plus 2 million in your long-term liabilities. So in total, you're gonna have your 7 million. Does that answer your question, or you want me to clarify it? Okay, perfect. Question 2, IFRS. So yeah, they don't specify in the problem that they have an existing agreement, so we cannot put in the long-term liability, so it all goes in the short-term liabilities. All right. For question 3, if instead of having a loan of $7 million, the bank only offered them $2 million and the company paid the balance of the short-term debt in cash, how would the short-term debt be presented on the December 31st, 2021 balance sheet following ACCO? So I'm just going to go and change my balance sheet, my timeline here. And basically here, instead of 7 million, we have 2 million. So what you're going to do here, the first one is the refinancing done with a long-term instrument? The answer is yes, but it doesn't cover your whole amount. It only covers 2 million. So you can't put your complete 5 million to your long-term liabilities because it's not the case. You only have 2 million that can go into the long-term liabilities. So what you're going to do is in your short-term liabilities, you're going to have 3 million that's not covered by your loan. And in your long-term liabilities, you're going to put the 2 million of the loan. So in total, in your liabilities, you're going to have 5 million. Is that okay? Well, yeah, exactly. Yeah, I'm talking to myself right now. For your question, Kathy, long-term, how come it's long-term for ASPE and short-term for IFRS? Because for ASPE, it checked all the criteria that were here. It checked refinancing done with like these three. So it means that you can put the whole amount in your long-term liabilities. It checked all the boxes. The amount is also greater than the loan, so you're good. IFRS, it did not fulfill the criteria to have an existing agreement. So you cannot put anything in your long-term liabilities. You should have had in the question, like saying, okay, management, well, they had an agreement to roll the short-term debt at December 31st, 2021 into this existing agreement. Otherwise, if nothing is mentioned, it all goes in your short-term liabilities. IFRS is more strict than ASPE on that regard.
Sorry, do you mind re-mentioning what the IFRS criteria is?
Yeah, can you see my screen?
Yeah, like I don't really understand what that means.
Okay. Basically, it means that they either already have a loan and the company that's loaning them, the lender, is saying, okay, you can put that amount that is due next year, you can put it under my loan and you can pay it back with the same terms as my loan, my long-term loan. Or refinance it, it means that they already had that agreement that we had on January 25th. They had it in like December 15. So they can refinance it before year end. Is that clear?
A little bit. I'm still a bit confused.
Yeah.
Like wait, so it's either they already have an agreement with the lender that they can push it to long-term debt. Is that it?
Yeah, so basically they can add it to their loan that they already have with a lender, and they just use the same term as the terms that they have with that lender to pay it back.
Okay, and what's the other case?
The other case is that they had a refinancing agreement like before year end, so on December 15th, for example, instead of after year end.
Okay.
Clear?
Yes, thank you.
Okay, perfect. So that's basically it for short-term debt refinancing. Does anyone have any other questions, or it's pretty clear? Also, am I speaking too fast? Like I feel like I'm just rambling on. All right. Okay, perfect. I'll go to question 2. This is about payroll and benefits. Oh my God. There's not much theory to it. I think I'm pretty much going to explain as I go. This type of question about payroll, it's 3 points on your exam. It's like, if you have difficulty, do practice on the book. In the book, there's really good examples. I really recommend, like it's E1311 or something like that. Like do it and it's going to be clearer, but there's going to be a question like this on your exam, and it cannot get really more complicated than what I'm showing you right now. So ABC Limited started operation on January 1st, 2020. The company employs 10 full-time employees. They are all paid $30 per hour for the year 2020 and $35 per hour for the year 2021. The standard workday is 8 hours. The employees get paid every 2 weeks on Fridays. They each pay $120 to their union every paycheck and have a deduction of $550 for income tax purposes. The CPP rate is 5.25% for the employees and ABC Limited. The EI rate is 1.58% for the employees, and ABC Limited pays 1.4 times this amount. As for the vacation days and sick days, each employee accumulates 15 fully paid vacation days per year and 5 fully paid sick days per year. ABC Limited has decided to accrue the vacation days benefit at the end of the year of when they're earned. The employees can take their vacation days the following year at their current early rate. As for the sick days, the company decided to only recognize sick days when they are used, and they do not accumulate if they are unused. In 2020, each employee took 0 vacation days and 2 sick days. In 2021, each employee took 10 vacation days and 1 sick days. A lot of information, we'll go through it as we go. So the first requirement is prepare the necessary journal entries to record the payroll made every 2 weeks in 2020 if the salaries and wage paid and the employer payroll taxes are recorded separately. So we'll start with the employee transaction. So we're going to go through each sentences in that and see, does it apply to our transaction that we're trying to do? So does it touch the employee? First of all, is that the employees are paid $30 per hour. So that's their wage. And we're doing 2020, right? So that's their wage for 2020. So that's their salaries. So we're gonna have to put that somewhere in our transaction. So the account for the salaries is salaries and wages expense. And the amount that we're gonna put in is $30 per hour times 8 hours per day, because the workday is 8 hours, times 10 employees, times 10 days, because they're paid every 2 weeks on Fridays, and a standard work week is 5 days a week. So you have an amount of $24,000. Then we continue. They each pay $120 to their union every paycheck. So you have an account that's called union dues payable. And yeah.
Can you just repeat what you did for the salaries and wages?
Yeah, I'll put it here with words instead of numbers. So it's $30 per hour times 8 hours a day.
Okay.
Times 10 days times 10 employees. So I just took these two sentences here and put them in my calculation.
Okay, thank you.
They can also just give you a gross amount saying they paid $24,000 to their employees for this paycheck. So you just put $24,000 and you don't have to do all the calculation.
Okay, thank you.
No problem. So for the union dues, it's $120 per employee. So we have 10 employees. So 120 times 10 employees. I'll put it here too. We continue. They have a deduction of $550 for income tax purposes. So that also goes for the employee, and the account is called employee income taxes deduction payable. That's the long one. And it's $550 times 10 employees. After the CPP rate is 5.25% for the employees and ABC Limited. So EI, did I skip it? No, CPP payable. So the percent that you see here is calculated on the gross salary. So you're gonna use your 24,000 that you found here, and you're gonna time it 5.25%. And you're gonna get an amount of $1,260. So 5.25% times 24,000. And then EI rate is 1.58% for the employees. So EI payable. Again, you calculate it on your 24,000. 379. And I believe that it is it for the employees. So we're the EI rate. As for the vacation days, that's another transaction. So we're going to plug the cash. That is what we actually paid to the employees, and just a plug number. So you do the 24,000 minus the sum of all your other credits. So both sides are equal. So we're not putting the vacation in here yet because they pay it at the end of the year. Some companies may I'll take that back. We're not putting the vacation in this transaction because it says that they accrue the vacation days benefit at the end of the year when they're earned. So they do it at December 31st. Some companies and some problems might accrue them every paycheck. So every paycheck you're gonna have like your salaries, expense, and then you're gonna have vacation payroll. That could come up in your problem. but you're gonna see the transaction later. Oh my God, I'm losing my voice. I'm not used to talking so much. Okay. Now, we have to do the employer portion. So the employer was only mentioned for EI and CPP, so that's the only thing we're gonna register. So we're gonna put payroll tax expense. Basically, this is a debit, it's an expense, and it's gonna be the sum of the CPP and EI that the employer has to pay. So the CPP payable, the rate for the company was also 25%, so it's calculated again on the 24,000. And for EI payable, it says here that the EI rate is 1.58% for the employees, and ABC Limited pays 1.4 times this amount. So it means that whatever the employees we put, like the amount for EI, we're going to do 1.5 and 1.4 times the amount. So it's 1.4 times 379 up here in our transaction. That's why I did the employee first, so we get the amount to do the transaction for the employer. So I'm going to put here 1.4 times 379, and the 379 was the 24,000 times 1.58%. And then you plug your payroll tax expense, which is just the sum of these two numbers. And this is the employer portion. And that's it for the requirement 1. For 2, it says prepare the necessary journal entries to record the payment to the Receiver General for Canada and to the Employees Union. So Receiver General for Canada is a fancy name for the government. So anything that needs to be paid to the government, that includes CPP, income taxes, EI. In French, I know it's ACCO, Assurance Emploi. So these things is a payment to government. And then union, employees union, then it's only your unions due payable that we register in the employee transaction. So we're going to do that now. What you're going to do is, since these are all liabilities right now, they're all payable, we're going to want to net them, pay them. So we're going to put down employee income taxes deduction, CPP payable, EI payable, and then you pay them by cash. So your credit is going to be to cash. Am I missing one? No? Okay. So employee income tax deduction, you only have in the employee transaction. So it's only 5,500. CPP payable, you have to add your CPP of the employee and the employer portion. And EI, same thing, you add the employee and the employer portion. And cash is just the sum of all three. So this is the Receiver General for Canada. And then unions too, payable for the employees union. And again, you pay with cash. All right, so before I pass to number 3, is there any questions about these 2 entries? No, okay, I'll go to requirement 3. Prepare the necessary journal entries to record the transactions related to vacation entitlement during 2020 and 2021. This regards CPP and EI in the calculation. So for 2020, we go back in our text here. They said that as for the vacation days and sick days, each employee accumulates 15 fully paid vacation days per year and 5 fully paid sick days per year. ABC has decided to accrue the vacation days benefit at the end of the year of 1 year earned. The employees can take their vacation days the following year at their current hourly rate. As for the sick days, the company decided to only, that's not for vacation. So in 2020, each employee took 0 vacation days. And in 2021, they took 10 vacation days. So for 2020, all you're gonna have to do is accrue the vacation days that they have earned during the year. I'm gonna show you the transaction. You're not gonna have to do a payment of vacations because they didn't take any days. So the transaction is salary and wages expense. It could also be a vacation expense. It's up to you which one you prefer, doesn't matter. And it goes to vacation wages payable. What we're going to calculate here, I'm going to put it like I did here on the side, so it's easier to follow. It's 10 employees times 8 hours a day times 15 days, because here they say that they accumulate 15 fully paid vacation days per year. And it's times their current hourly rate, which is $30 per hour. Put it here again, 10 employees times 15 days times 8 hours times $30 per hour. And your credit is going to be the same, 36,000. That's it for 2020. I didn't take any vacation days, so you can just leave it there. For 2021, we're going to do again, we're going to accrue first what they earned during the year. So it's the same transaction here, same accounts. The amount is going to vary. So now it's 10 employees times 15 days times 8 hours per day. And the current hourly rate changed during 21. They're not $35 per hour. So now it's $35 per hour. And it's the same credit. So I'm going to put it here, the calculation. Now, it says in the problem that in 2021, each employee took 10 vacation days. Because there's been a change to their current hourly rate, we're gonna have to do some little math here, because their bank is at $30 per hour, but they're gonna take it at $35 per hour because the company says somewhere in the problem that here, that the employees can take their vacation days the following year at their current hourly rate. So that means in 2021, they can take their vacation days at $35 per hour, even if their vacation bank is currently at $30 per hour. So to account for that, we're gonna first, I'm gonna skip an account here because I want to do it after, but first you're gonna calculate how much of the vacation wage payable have we paid. So this amount, this account has been accrued at $30 per hour. So we're gonna use again $30 per hour to reduce it by. So it's, just make sure I'm at the 10 employees times 10 days, because each employee took 10 days, times 8 hours, times $30 per hour. This is the bank, what we accrued in 2020. And it's 10 employees times 10 days times 8 hours times $30 per hour. What we paid them is the same calculation that we did here, but instead of 30 here, we have $35 per hour, because they're, for 2021, their hourly rate is $35 per hour. Now our debit and our credit are not the same. There's a 4,000 missing, and you're gonna just put it in your salaries and wages expense account. So you plug it here, and now your transaction is gonna bounce. Is there a question for this one? I know it's a lot of numbers. It's the most complicated I could have done it. I think at the exam it's gonna be a little bit easier. So if you understand that, then you're good to go. All right. So for requirement 4 is prepare the necessary journal entries to record the transaction related to sick days during 2020 and 2021. Disregard CPP and EI in the calculation. So for sick days, they said that The company decided to only recognize sick days when they are used and they do not accumulate. So basically, whenever an employee takes the sick days, then the company is going to do a transaction. They don't do like the vacation here, and they at the end of the year they accumulate everything they earned during the year to just do what the employee took. So for 2020, each employee took 2 sick days. So it's again the same account, salaries and wages expense. Calculation is 2 days times 10 employees times 8 hours times $30 per hour, the current hourly rate. And they paid it immediately because they do it as they're earned, so they already paid for the sick days, so it's just cash for that amount. And then for 2021, it's the same entry, but instead of 2 days, they each took 1 day, and it is now at $35 per hour. So I did not do that right, 35. One days. All right, and that's it. That's it for the transaction. Is everything good with question 2 before I move on? I'll take that as a yes. Perfect. Question 3 is about asset retirement obligation. This is always the same thing. You're always going to do the same steps. It's always the same. So if you do 1 or 2 problems, maybe 3, if you have more difficulty, you get the hang of it and you're going to be fine for the exam. And in the future, if you do that in your work. Again, I have a little video from Farah that I think is really good if you want to listen to it to get more information. So, an asset retirement obligation happens when a company has a long-lived asset. Long-lived asset is an asset, it's basically an asset that's in use. I started my sentence without thoroughly knowing what a long-lived asset was. But basically, it's an asset that you use to produce something. Normally, it's like a mining plant, oil drilling platform. It's stuff that like you're putting it up to do a project that's gonna have some consequences in the future. Like I put some examples here of like when an asset retirement obligation happens, but like you see a nuclear facility, oil and gas properties, mining facilities, landfills. So it's very much like a construction site or stuff like that. And basically at the end of the project with the asset, you're gonna have to take it off. And taking it off, removing it is gonna generate costs for the company. And before the project begins or at the start of the projects, they have an estimation of what the cost is gonna be. And they're gonna have to account for it. They're gonna have to do some provision in their liabilities for the future costs of removing that asset. The future costs are recognized at the present value of what they imagine. Normally in the problems, you're going to see they estimate that it's going to be $1 million in cost to remove it. They're going to give you an interest rate. They're going to give you a period of how long the project is going to be. IFRS recognize legal and constructive obligations. That means contracts, laws, that's all legal. Constructive obligations, it's like the company always decided to plant a bunch of trees when they're done with the site. So that would be a constructive obligation. So they have to take into consideration the cost and put it in their asset retirement obligation. ACCO only recognize legal obligations. So only stuff that they have to remove because of contracts, laws, etc. There's steps for asset retirement obligations that you can follow, and it's pretty much the same thing every time. So first, you have to capitalize the asset at acquisition. So you have to recognize that you purchased an asset. Then you recognize the arrow at present value. And at the end of each year of the project, so if the project is 10 years long, so you're going to do these transactions 10 times. You're going to do one if there's a production cost. So if there's if the activity during the year produce future restoration costs, you're going to have to recognize that. I'm going to explain it a little bit better when we're doing the problem. You're going to have to recognize the depreciation for the asset because it's a long-term asset. And you're going to have to recognize the interest expense or accretion expense to, I just have amount to add to your arrow provision. Because at the end of the, let's say, 10-year project, you want the balance in your arrow account to equal your estimation at the beginning of the project. So a lot of talk. I'll go into the problem. Like I said, if it's not clear, listen to the video. He really explains it well, what it is and what it entails. So for question 3, Beryl Industries buys an oil platform on January 1st, 2021 at a cost of $2.5 million. The platform is expected to remain in use for a period of 10 years. After the 10 years, Beryl Industries is legally required to dismantle and remove the platform. The total cost of dismantling and removal is estimated at $650,000, with 20% caused by the platform in production accrued at the end of the operating year. Beryl Industries uses a 7% discount rate, straight-line amortization, and has an operating year ending December 31st. The first requirement is prepare the necessary entries to record the acquisition of the platform on January 1st, 2021 under IFRS and ASPE. So first thing we have to do, it's the same transaction for both IFRS and ASPE. There's no changes. You're going to have to record the purchase of the asset of the oil platform, and you're going to have to recognize the arrow, which is the $650,000, the estimation of the cost of removing the oil platform when the project is due. Right, the first transaction, you know it. It's property, plant, and equipment, drilling platform, and it can be cash or accounts payable, depends, whichever is fine. And it's of $2.5 million. Did I put enough zeros? Yes. And it's the same on this side. So this is the acquisition of the asset. Then for the arrow, I'm going to put the accounts and I'm going to explain after how we calculate it. So it's, again, you put it in your asset because the project just started. You want to capitalize it. And then the credit is the arrow. Like I said earlier, you want to recognize at the beginning of the project the present value of your future costs. So you're going to have to pull up your financial calculator, the PV function, the table if you want. It says in the problem that they say that the total cost of dismantling and removal is estimated at $650,000. So you would assume that your future value would be $650,000, but because it says that 20% is caused by the platform in production, that means that they estimate that during the 10 years, the work that they're going to do during those years are going to take 20% of that amount of the $650,000, and they're going to record it every year. So they're going to increase every year by the 20%, if that makes any sense. So at the beginning of the project, you want to take the 80% of the $650,000 for your future value and not the complete amount. So instead of $650,000 in your calculation, you're going to take $520,000. calculation is the PV function. Your rate, it says here it's 7%. The number of periods, it says that it's a 10 years project. There's no payment, and the future value is the $520,000. Type, it doesn't really matter, I think, for this calculation, because there's no payments. So you get an arrow at the beginning of the period of the project of 264,000. That's all the transaction you have to do at the beginning of the project. You have to record the purchase of the asset and then your present value of the arrow. Then for requirement 2, is it clear for the 20%? Because it could be confusing a little bit, but I think it should be good. It's basically like costs that they entered during the year. Requirement 2, record any entries related to this asset and obligation on December 31st, 2021 under IFRS and ASPE. Barrel Industries estimates that the increase in the arrow in 2021 due to the production of oil in 2021 was $20,000. So under IFRS, if we go and look at my little steps here at the end of the year, it says that 1, if there's production costs, you're gonna have to record it. So under IFRS, it says here, production costs, your debit is going to be manufacturing overhead, and your credit is going to be to arrow. So you actually increase your arrow of $20,000. There's no mention that there's production costs in your question or whatever, you don't have to do it. There's not always production costs during the year. It depends. One year, it could be $20,000. Another year, it could be $0. Another year, it could be $1 million. It depends. So this amount will always be given to you. After that, you're going to do the depreciation for the asset. So it's your regular depreciation transaction. So you do depreciation expense, accumulated depreciation, drilling platform. And you're going to go and look at the beginning of the project. What did you put in your asset? You put your $2.5 million, but you also put the present value of your arrow. Oops. I forgot to put my function. All right, and then it says here that the useful life is 10 years. There's no remaining value after, so you just have to divide by 10. Yes, I'm sure I made a mistake. I have the same. Okay. So I'll put here what I did. I basically did 2.5 mil plus the 264K divided by 10 years. It's gonna be the same entry every year, except if there is a change in estimate that we're going to see later, but basically it's always going to be that for 10 years. And then 5 is the recognition of interest expense. So under IFRS, you put interest expense, and then it goes in your arrow. So you increase your arrow. So this is just the amount that you've put at the beginning of the year times 7%. So times your interest expense, your interest rate. It's been a long day. I'm sorry. I keep making some little mistakes. So this, I did the 264K times 7%. And that's basically it for transactions for the year for IFRS. So your arrow at the end of the year, so arrow on December 31st, 2021 is going to stand at your 264K plus your 20,000 plus your 18,000. So you have a balance of $302,000. The goal is at the end of the 10 years is going to be equal to $650,000. So every year you increase it a little bit. Under ASPE, transactions are exactly this. Well, not the amounts are the same. The counts, titles vary a little bit, depends, but should be fine. So for your here for your production costs, you're not going to put it in your manufacturing overhead. you're actually gonna put it in your assets. Well, drilling cost. Your depreciation, same amount. Depreciation expense has to take into account. No, you're gonna take it into account the next year because you're adding at December 31st, so it shouldn't be depreciated for 10 years, it should be depreciated on 9 years. So when you're gonna do for 2022, your depreciation, you're gonna have this amount, and then you're gonna have the 20,000 divided by 9 years that's added to it. So that's gonna be for 2022 your depreciation expense, but not for 2021. And then here for it's not interest expense, it's accretion expense. And for ASPE, that's it. With the transaction, it's the same calculation as for IFRS for now. I'll continue to requirement 3. Assume that at the end of the 10 years, Barrel Industries pay $900,000 for the dismantling and removal of the oil platform. Record this cost of dismantling and removing the oil platform. So now, when do we account for the 20% cost by production? Basically, it's your 20,000 here. They're going to tell you every year how much is caused because of production costs. And at the end of the 10 year, it should be equal to 20%. So here you did a little bit of the 20%. Next year, you might do a lot of the 20%. It depends, each year it varies. No problem. So basically what happens here is that they're retiring the asset. So you want to remove your arrow. They actually paid an amount. They actually paid 900,000 instead of 650,000. So you're going to have a gain or loss that's going to go in your income statement because it's not the same amount that they expected it to be. So at the end of your 10 years, the arrow should be equal to 650,000 if you did your calculations right. I'm going to leave that blank for now because I don't know yet. Well, I know it's a loss. I'll put loss, but you can leave it blank and plug it in after if it's a gain. It's a loss because what you actually pay, your cash, is greater than what you estimated. So your loss is going to be of 250,000. And going in the income statement, your arrow is now net. There's nothing in your financial statements for the arrow anymore. And you're good. And 4 is when there's a change in the amount that you think the arrow is going to be at the end of the years. So I'll read the question. Using the same data as presented in the problem, assume that on January 1st, 2024, the expected cost to dismantle and remove the oil platform will now be $1,250,000. No increase in the arrow due to production of oil was made after 2021. Prepare the journal entry needed to account for this change in estimate at January 1st, 2024 under IFRS. So first, what you want to go find is how much your arrow is on January 1st, 2024. And then you want to go and find what's the present value of your $1.25 million. And then you're going to increase your arrow by the difference between the two. So first, I want to find what's the balance on January 1st, 2024. So at the end of the year in 2021, your arrow was your 264K plus your production cost here, plus your interest expense. That was your balance on December 31st, 2021. In 2022, no production costs. So the only thing in these transactions that touch the arrow will be your interest expense. So your interest expense is the same. It's this amount times 7% plus this here that you already had. I should have done just times 1.07%. Okay, doesn't like it. right? So it stands at $324,000. And then for on December 31st, 2023, which is the same as January 1st, 2024, is going to be this amount times 1.7%, because again, there's been no change. There's been no production costs. So this is your balance that we want to look at for January 1st, 2024. Second step is to find your present value of the $1.25 million. So your PV at Jan 4, 2024, your rate is again 7%. Number of period is now 7 years instead of 10, because there's been some years that has passed on the project. There's no payments, and the future value is 1.25 million. Type doesn't matter, there's no payments. All right, so your present value is $778,000. So you want your ARO account to be of this amount now on January 1st, 2024. You don't want it to be your 346. So what you're going to do, you want to increase it. And to increase it, you credit your ARO, and your debit is going to be in the asset directly, because it should have been at the beginning of the profit, right? So the difference between the two, it's the $7,000 minus $300,000. It's $431,000, and it's the same in your ARO. So that's how you account for a change in estimates for asset retirement obligation. Any question on this? I think we're going to end a little bit early, but that's okay. So for product warranties, there's two different types of warranties. There's the expense approach, which is when the warranty is sold with the item. You cannot buy the warranty separately, and the warranty is expense when the good is sold. And there's the revenue approach, that the customer has the choice to buy it or not, which will generate unearned revenue, and you're going to put in your warranty revenue when the warranty is actually used. So, for question 4, Zellers Inc. sells laptops with a 2-year warranty against defects. They sold 300 laptops on account during 2021 for $1,500 each. Their laptops had a cost of $750 per unit. Zellers estimated a total cost of $75,000 for servicing their warranties for 2 years. During 2021, they spent $45,000 servicing the 2 years warranties that are included in each sale of their laptops. All transactions are paid in cash. The first requirement is prepare the 2021 entries for Zellers Inc. using the assurance type, expense base, there's 2 names, approach for warranties. So first thing you're going to do is you're going to recognize the sale. So you sold 300 laptops for $150,000 each. So your accounts receivable, sales revenue, and it is 300 laptops times 1,500. Guess what's it called? Yeah. I didn't do this right when I was setting it up. All right, and it's the same sales revenue, and you have to take into account your cost of goods sold, which they said that the items had a cost of $750, and this decreases your inventory. So that's your first transaction. You've already seen this, so we're good to go. For accounting for the warranty expense, there's 2 ways to do the transaction. At the end, it's the same thing. I'm going to show you one and then the other, and I'll show you why it comes out to the same thing. I have a preference for the first one because it's less calculation, but do whichever you find easiest, or whichever you've been shown by your teacher. So for the first method, what you're going to do is you're going to expense the total estimated $75,000. So You're going to put your warranty expense, and you're going to put $75,000. And the credit is liability warranty for the same amount. You've actually had $45,000 for providing the warranty. So you want to come and decrease your liability warranty, and you paid it via cash, via inventory. The other account really doesn't matter that much, for $45,000. So that means that on your financial statements, in your income statement, you have a warranty expense of $75K. And in your balance sheet, well, I'll skip the cash, but you have a liability warranty of $75,000 minus your $45,000. So you have a liability warranty of $30,000. So that's the first method you can account for it. The second one, which I think has been shown to you in your classes, is that you're gonna actually expense your $45K, so the actual cost of warranty. And this goes to cash. And then you want to add to your warranty expense at the end of the year, the difference between what you actually spent and what you actually think you're going to spend. So you want to add 30K. So it equals 70K. So you're going to add to your warranty expense 30K. And the credit account is your warranty, the liability warranty of the same amount. So if we look at the financial statements, in your income statement, you're going to have a warranty expense of 45 plus 30 plus 30K. And then in your balance sheet, you're going to have a liability warranty of 30K. So it's exactly the same as what we had earlier. So pick the one that is easiest to you and you're the most comfortable with. And then for requirement 2, we're going to look at the revenue approach. So prepare the 2021 entries for Zellers Inc., assuming that the warranties are not an integral part of the sale, but rather a separate service that is considered to be bundled with the selling price. Assume that of the sales total, $90,000 is identified as relating specifically to sales of warranty contracts. Zellers Inc. estimates the total cost of servicing the warranties will be $75,000. Use a service type revenue-based approach. Warranty revenues are recognized based on the proportion of costs incurred out of the total estimated cost. So your first entry that we did here to recognize the sales, now you have an unearned revenue for the warranty also take into consideration. So you have, again, accounts receivable. I think of the same amount. I'm not going to do it again, but it was $450,000. And then you have your sales revenue, and you have your unearned revenue that is for the warranty. It says in here that of the sales total, $90,000 is identified for specifically the warranty. So you're going to put your $90,000 for the unearned revenue, and your sales revenue is just going to be applied. They might say that it's a percentage of the sale is given for warranty contracts. That's the problem, but pretty sure you could figure it out while you do the problems. And then again, you have your COG, your inventory. Do you? Yeah, you do. Which is the same as earlier, which was this amount. All right, so after that, you want to expense the actual amount of warranty you spent for servicing customers. So it's the same amount as earlier. So they actually spend $45,000. So this is going in your warranty expense account. And let's say that you paid them back the cash. So it's going to be the $45,000. And now you have to recognize some of the revenue, warranty revenue that we put in unearned revenue earlier. So you want to decrease your unearned revenue and you want to put it in your warranty revenue. The amount, it says here that it's based on the proportion of costs incurred out of the total estimated cost. So you actually incurred $45,000. The estimation is still $75,000. So you're going to do 45 divided by 75,000. And then you do times your 90,000 of unearned revenue. So you're going to have a warranty revenue of $54,000 for the year. And that concludes question 4. Is there any questions about this? Any subjects I've covered or just the tutorial in general? I'll stop recording